Good evening, everyone. My name is Neil Bawa, and I'm your host tonight. My fellow partners Anna Myers and Rich Day are with me, and we can't wait to get started with tonight's event. Say hello, everyone.
Hello, hello.
Hey, how's it going?
Fantastic. Well, many of you are probably wondering, Neil, why should I invest now instead of waiting on the sidelines for a better deal when market conditions improve? Well, we have this to say. By the end of this presentation, you will agree with us that this project and this asset class is now more compelling than it was pre-COVID. In every recession, there are lots of losers, but yet, yes, there's also winners. And we believe that this project and this asset class will benefit from the pandemic. And that is a key part of our story today. To kick off, we'll give you a brief introduction to the management team, and then we are going to introduce you to the concept of flex industrial. Then we will review why we chose Salt Lake City for this project, and we will explain why we cherry-picked this particular neighborhood, and then we'll tour the property. Finally, we're going to run through the assumptions, the returns, the minimum investments, and the time frame, and we'll do a Q&A session at the end. All right, and some housekeeping. Feel free to type in your questions into the Q&A box. Anna will be asking us those questions at the end. You will get a video recording of this webinar in your mailbox tomorrow, just in case you need to jump off. Please note that the numbers might change, though we think they're pretty dialed in by now. Our lawyer wants you to know that this webinar is not a solicitation to purchase securities. For that, you would need to review the PPM and the subscription docs. This is an informational summary. It's a marketing summary. It's not a substitute for your due diligence. Now for the team, I'll start off. I serve as founder and CEO for both Grocapitus and Multifamily University. Most of you on the call know us, and over 100 of you have invested in our projects. You've trusted us with your money, and I'm happy to say that you've already seen very positive post-coronavirus updates on the resiliency of our current portfolio. If you've been listening to our town halls and webinars, by now you're used to us talking about the benefits of the industrial asset class. So it's only normal that we've been spending a lot of time looking for best-in-class operating partners in the industrial space. And we are super excited to be working with Rich Day. He's a well-known Salt Lake City developer with the experience, the savvy to build high-quality flex industrial projects. Rich is quite resourceful. He's got a very diverse experience set, and he is boots on the ground in one of the fastest growing parts of the US. Before I introduce Rich, I want to briefly share our portfolio. This is little over half of the Grocapitus portfolio. For those of you new to us, we focus predominantly on apartments with some student housing and public storage sprinkled in, but we're data geeks. And over the last 2 years, the data was pointing to industrial as the next great asset class. So we're really, really happy that we are now able to add industrial assets to our portfolio. We're especially excited about the cash flow potential that Woods Cross offers. We've never launched a project with a projected cash flow in the 13% range, so that is new to us. Super exciting. Before I ask Rich to take over, I want to spend a minute sharing our thoughts about a post-coronavirus world. So what are we thinking today? The truth is that change was upon us before COVID-19, and we recognized it. The multifamily value add world was losing its value before the pandemic, so we created a 5-point change plan. And the main theme for this plan, we call it Grocapitus 2.0, was that we needed to build a defensible moat around our projects. First, we needed higher resilience, which meant that we needed to move to projects with multiple exits, keep them for cash flow, exit quickly for higher IRRs or multiples. We also decided to make our projects smaller, so there are more buyers for them. Plus, we're focusing more on multi-purpose projects. For example, flex industrial zoning allows both industrial and office as a mix. Also, we decided to speed up our projects and reduce our construction timelines because speed to cash flow is key today. So the projects themselves had to shrink in size and the cash flow had to come in year 2, not in year 3. Also, each project needed something unique for differentiation. So combining solar and EV charging for our self-storage projects and adding wellness for new construction quadplexes With the Woods Cross project, our key differentiator is the incredible strength of this market and submarket, and you're going to learn about that today. We also needed to create offerings that were productized, like an assembly line, so we could give our investors more than the one standard exit that syndicated investments offer. With Woods Cross, we have the option to sell all of the building or keep some and sell others. And finally, we're really focused on projects that get over the current capital market debt challenges. Whoops. To that, we're simply staying away from projects that are likely to have lending problems or high interest rates. We feel that the Fannie Freddie 9-month impound requirement for value add projects are a risk element. We don't want our investors exposed to it. Also, we're working with teams where the resume is really strong because banks today are lending to very strong and experienced teams. In summary, we're going to tell you how exactly we implemented this 5-step strategy for Woods Cross. And now I'm going to ask Anna to introduce the rest of the Grocapitus team. Anna?
Thanks, Neil. Hey, everybody. I'm the vice president here at Grocapitus, and I am the professional plate spinner of the group. When you see sparks flying at Grow, I am the sparkler in chief. For our first foray into industrial, we're thrilled, really thrilled, to have a truly shovel-ready flex industrial project located in the amazing Salt Lake City Metro. It's really a mega win-win. So as a partner on the project, I will be working diligently to keep our investors' returns on track. Also working with me is our financial controller, Loretta Hayes. She always adds tremendous value to our investors. She's got decades of experience in both construction and financial industry. And every month she scours the construction schedules and the project financials, looking for any dark holes and really just keeping us all on track. Our team also includes a virtual army, starting with our efficiency center managed by tax sharp Nadine. We use cutting edge marketing technology to help our properties lease up and really optimize them in lots of ways. We finally have our equity squad headed by wonderful April. And if any of you will be investing with us, you will be talking with her quite a bit. Now I'm going to hand off to Rich to introduce himself and get this party started.
Thanks, Anna. I'm bummed that you took the title of Sparkler in Chief. I was going that direction too. It's funny, actually, I'm looking at this map and it looks like I'm avoiding Nevada. I'm really not. I actually think the market's great. Maybe I'm going to surround it and then we'll attack it eventually. But my background has always been in real estate. I started when I was 21 years old working the debt financing while putting myself through college. And it was actually during my graduate program that I transitioned into private equity. And I was working for an investment bank, which focused specifically on institutional real estate. And I started sponsoring my own deals about 8 years ago, mostly focused on value add acquisitions back when you could buy for less than the replacement value. But now I'm actually seeing a lot more opportunities on the development side. And ultimately for me, the why I do what I do in the real estate world is so that I'm a big fan of supporting good causes. I sit on the board of both the Tony Finau Foundation as well as the Make-A-Wish Foundation. And for the last several months, I've been working closely with the Operation Underground Railroad. As you're looking at the slide here, you can see a quick glimpse of the projects I'm either working on currently or I've done in the past, including a few that have gone full cycle. In fact, in the last 8 years, I've had more than 16 properties that have gone full cycle, which means I bought them, managed them, maintained them, and then sold them. And those 16, my average IRR is over 24%.
Sorry, Rich, I'm going to jump in here for a second here. It's really phenomenal for our investor base to have the opportunity to work with someone that has had so many properties go full cycle, and especially given that the average IRR that you've achieved, for your investors and yourself, is 4x what the stock market has achieved. So just wanted to share my excitement at having you with us.
No, jump in anytime you want to share excitement about anything I've done. So I appreciate it. Currently, I've got about 1,000 apartment units under development right now, with another 200 townhomes and about 500,000 square feet of industrial projects. As we jump into the discussion of the industrial flex market, I wish there was a chance for me or opportunity for me to ask everybody about your experience in this space. It's such an exciting thing for me. I love this area and I'm thrilled to share it with everyone. But it seems as though it's not really much of a secret anymore. I thought I had a kind of a golden nugget, but I'm finding out more and more that more people know about it, including the Emerging Trends in Real Estate survey that was just published. It says the industrial remains the most attractive property type, both for investment and development. And over the last 10 years, the quarterly industrial returns, total returns across the entire United States have been on average about 12.9% annualized. And if you look at other non-industrial product types, we're looking at closer, well, at less than 10%. So as you can see in this quote, if you believe the industrial markets, let's see, if you believe in industrial 3 weeks ago, and keep in mind this quote is from April of this year, then you should be a believer today, especially after the COVID crunch and associated e-commerce surge. Here's the thing, when you're looking at long-term investments, it's really important to look at industrial in anything you're doing. The supply shift, or the shift in the supply chain strategies from just-in-time inventory systems is changing the whole marketplace. The way we all order supplies, food, clothing, literally everything, it needs to be stored. It all needs to be stored in and ready for delivery in these industrial spaces. And just looking at how far we've come since 2010, the industrial market distinctly outperformed the other markets with a cumulative return of 250%, specifically in primary markets like Salt Lake City. If you're looking at short-term advantages of the industrial, and the fact that 50%, which is interesting that as you look at the slide, 50% of the projects that are due to deliver this year in 2020 are either pre-leased or build-to-suit products, and that's phenomenal. Usually when we build other developments, we do it all on spec. We build apartments on spec and office a lot of time on spec. With hopes we can have something pre-leased during construction. But the reality is the entire United States, more than half the projects that are set to complete this year have already been spoken for.
Sorry, Rich, you know, we're coming from a traditional multifamily world. I can tell you that having 50% of your project pre-leased is just terrific. We just don't have that assurance on the multifamily side with new construction.
No, you're absolutely right. If we did, that would be amazing. It's certainly a competitive advantage that industrial has. So it's my experience. I recently bought an old Kmart that was vacant and run down and tired. And the idea was to redevelop the entire city block. And it was funny to me because the gentleman from whom I bought it said, I wish I would have never bought this Kmart. They told me they didn't plan to ever shut down. And here it is only a few years later and they've already closed their doors. And it's crazy because all you have to do is look around and you would know that retail is not the same as it used to be.
Oh.
And the data shows all that. So keep in mind, e-commerce grew by 15% annually, and that was before COVID. So with this whole shelter in place, the e-commerce world has exploded. We just learned that e-commerce grew by 77% year over year from June 2019 to May 2020. So keep in mind, that's about 35 times the speed of the US economy. And most of that was all post-COVID. So in fact, I think the latest statistic I heard we're not seeing any GDP growth is actually an infinite number. So here's the thing. The industrial market will only get better as we back away from dependence on foreign imports too. So we need to keep that in mind. As we're looking at talking about the ongoing and truthfully the pun, ongoing need to house e-commerce, but keep in mind there's a bunch of other industries that look at the industrial space for officing too. So in fact, one of the tenants that we have in LOI is a med device company. So as we look at the rising e-commerce trend and demands, we can't forget about all the other industries that look at this space as well. But we can talk more about that, or I'll talk more about that later. So as you're looking at these vacancy statistics in the industrial forecast, the US stats are awesome when it comes to vacancy. And then if you look for the asking rental increase. So even in the financial downturn in the markets of 2007, here in Utah, the worst we saw was a 6% vacancy. We're literally 94% occupied throughout the entire crisis. So wow. It's true we didn't build a lot. We didn't have a lot of construction going on, but we weren't losing industrial buildings back to the bank like we're seeing in other areas like hospitality or retail or things like that.
And Rich, I wanted to point out that the 6.8% asking rent increase projection, which is from Cushman & Wakefield, I think, that's the highest for any real estate asset class in the US, right? Just doesn't matter what kind of asset class it is, nothing comes close to industrial for 2020.
Yeah, asking rent increase of 7% it's unheard of. So again, as a developer, I'm not trying to build products that people don't want. I'm not out there looking to develop speaking of Kmart's, I'm not trying to build a Kmart or a Blockbuster video.
Oh, no.
I specifically picked industrial because it remains the most attractive property type for both investment and development. And as you can see in the words right here, an investor's darling are words that we have come to hear so many times from many different experts, not just, as Neil said, the people from Cushman and Wakefield. It's a great asset class. So the flex industrial, which is short for flex space, allows for a business to tailor whatever their needs they might have. So you can see the bullet at the bottom point, the bullet point at the bottom shows the uses that are allowed. And if you look, you can even notice that the startups are even use them. So while we're considering what to build, I think about groups that do research and development or general retail or third-party logistics, in addition to all the e-commerce company. Because all these companies need places for manufacturing, packaging, shipping and receiving. And nowadays, when it comes to the office space, we do so much banking, borrowing, lending, entertaining online. We don't even see we see old retail units convert to warehousing because it makes a lot more sense. And these flex spaces are perfect to support, big e-commerce giants like Amazon. So this slide here kind of gives you a concept of how some of the space works. It's not uncommon to see 10 to 25% front office space, or front office or management space. But then you have an area where you can, if you're the owner of that company, you can walk directly back to see where your team is on an R&D project. And then after checking in there, you make sure that shipping and receiving, or that things have been, shipment has been sent. And we see this more and more in the US as this type of space is much less expensive to rent and it's more fluid for growth. And the lack of all the complexity of maintaining an image for walk-in traffic, where right now the website's really your storefront.
Yeah, that's true.
And Utah is growing like mad. And being a part of a project like this reconfirms the marketplace and the opportunities here. But obviously I'm a little bit biased about Utah and the Utah market. So and I know you know quite a bit about the Utah as an investment area.
Yep, I've been doing my research. Salt Lake City, gorgeous, isn't it? Those incredible Utah mountains. Well, let me show you a map to orient you to where our project is located within the metro. So up here, this is Woods Cross, and it's, you can see it's about a 12-minute drive from downtown, and really just a hop, skip, and a jump from the airport. And next, we have more beautiful mountains, this time with snow. And now let's check out a video to set the stage for why we love investing in Salt Lake City.
Named one of the strongest performing cities in America by Forbes magazine, Salt Lake City is a central hub for business, travel, and recreation. This city we call home is the only place you can play golf in the morning, work for a cutting-edge startup during the day, then go ski touring in the evening. With its out-the-door access to world-class ski resorts, wilderness, and national parks. Salt Lake City offers a work-life balance you can't find anywhere else. In addition to its outdoor lifestyle offerings and thriving economy, the city has a vibrant urban culture that includes performing arts powerhouses like Utah Symphony and Ballet West, innumerable award-winning restaurants, and an ever-growing art scene. In terms of intellectual stimulation, the University of Utah is renowned for its medical school, MBA program, research facilities, and honors program. The university has fostered more biomed and tech startups than any school in the nation, including MIT. With the Silicon Slopes effect in full sway, Salt Lake and its surrounding areas are great places to live and buy property.
Yep, Silicon Slopes is in full sway. And those strong economic fundamentals, it's like a siren song to us data geeks at Grocapitus. With job growth at twice the national average, 3% job growth, and steady, strong GDP growth, Salt Lake City has had our attention for a while. Well, We know that every city is going to take a hit with Corona, but Moody's pegs Salt Lake City as an explosive tech hub that, due to pre-Corona fundamentals, is well positioned to be one of the fastest rising metro areas in the US post-Corona. Yep, Salt Lake City is a vital, innovative community with lots of claims to fame. Besides being in the top 10 cities projected to recover faster post-COVID, SLC is a place that revels in work-life balance. It was #1 for best life expectancy due to the more affordable living coupled with all those gorgeous outdoor activities, and it's best in class for hospitals and healthcare. Check out the highest growth startup and job creation. This is fed by the young, highly educated population. The average age there is 30, by the way. And the fact that these millennials can afford to live and play here. The airport is #2 in the US, also a big part of this story, and Neil's going to talk about that later. So Salt Lake City is a booming tech hub. Again, those famed Silicon Slopes, and it's attracting major companies like Adobe, Microsoft, Facebook, Google, and it's home to at least a half dozen unicorns. Those are companies that are valued at $1 billion or more, and there's plenty more soonicorns expected to hit that mark soon. And really, why wouldn't tech companies be coming here in droves? There's affordable rent, low cost of living, high concentration of top-notch tech talent, and that surging millennial population, which is the largest pool in the US. So let's talk a minute about population. First, I want you to notice that 3.1% forecast in
Wow.
1 year. That's crazy. And while it's no secret that Mormons have lots of babies, which is a contributing factor to why the population is so young and growing, but Salt Lake's population growth is based on more than that. It's accelerated by net migration. People from out of state, they are drawn to Utah. They come for the universities, the jobs, the gorgeous outdoor activities, and they're coming from all over. They're coming from California, Oregon, Washington, Texas. And in a post-Corona world, Salt Lake City is going to be very attractive, as many people will continue to work from home, but they want a vibrant, affordable city with a hot economy that's more spread out. If you think about dense cities like LA, San Francisco, and New York, those are the places people are going to be leaving from, but people still want an urban experience, and Salt Lake City can give them that in a less dense package. So when you combine the homegrown population boom with the net migration, Salt Lake City is poised for bright days ahead. But in our new COVID reality, there's one factor that matters more than any others, and that is jobs. Pre-Corona, Utah and Salt Lake City had an amazing job growth story, more than twice the national average. And look at those jobs. Beautifully diversified. Show them the pie, Neil, show them the pie. Beautifully diversified in this multicolored pie. But now we live in a different reality. 30 million people are unemployed. The US average unemployment is hovering around 11%. Where has that left Utah? Well, Utah currently has the second lowest unemployment rate in the nation at 5.1%. Yup. They were 2.6% a year ago. Those strong economic fundamentals kicked in to help. Also, Utah never fully shut down their economy during COVID. And look at Davis County. Davis County is where our site is located. It has an even lower unemployment rate that is a mind-blowing 4.7% in COVID times. So that's really a quarter of what US cities are facing now. And it's lower than some counties were even pre-pandemic. So do we have jobs? Yeah, you betcha. But where will these jobs be? The 5-year forecast is dominated by high-paying, white-collar work in education and health, infotech, finance, professional services. But how do these jobs play with the industrial space in Salt Lake? Do these jobs create demand for the asset class we're here to talk about tonight? Well, let's ask Neil.
Thank you, Anna. As strong as Salt Lake City's growth is, what matters more, in my opinion, is the demand in Salt Lake City specifically for the flex industrial product. And as we dug in on the demand, we were just blown away by how strong it was. To get started, here's a key comment from CBRE, which is the big dog in the industrial leasing space, about the surge in demand that Salt Lake City is experiencing. Note that the demand is broad-based. It's coming from both e-commerce and the logistics sides. We're data geeks and we make our decisions based on numbers. So we really like the story that the numbers tell about this rapidly growing asset class. As our investors know, we love multifamily and we love comparing other asset classes to multifamily. So just some critical numbers on the screen for you. Vacancy in the industrial sector in Salt Lake Metro is about 3.7%. That's around 50% lower than multifamily vacancy, which is around 5.7%. Asking rent growth is about 6.5%. That's almost double the rent growth of multifamily. Most importantly, cap rates in industrial are in the 6 to 7.5% range. This means that industrial assets are very reasonably priced compared to multifamily cap rates, which are in the 5 to 6 cap rate. Reasonable pricing means more headroom for future price growth. Just as important as the numbers is the quality of the companies that are coming in to use that new space that's being created. Now, recently I heard that almost 80% of the growth in the US stock market in the S&P 500 comes from just 6 technology companies. So it's awesome to see that 3 of these 6, Amazon, Google, Facebook, are all opening or have already opened large data centers, or in Amazon's case, large fulfillment centers. But I don't want to downplay the other logos up there on the screen. Utah Inland Port Authority is constructing a brand new inland port. This inland port is 16,000 acres, which is 25 square miles. Note that the island of Manhattan at 22 square miles is smaller than this huge multi-billion-dollar inland port. The University of Utah is opening a student village. That's $1/3 of $1 billion. Note that Utah's universities have not been as impacted by COVID as other universities have, and their fall enrollment, very strong. Salt Lake City has always been my favorite airport in the US, and it's getting better. This airport, which is ranked 2nd best in the US, is already undergoing a massive expansion because of the very rapid business growth that Utah is experiencing. By the way, did you know that Utah's been ranked in the top 3 states in the country for GDP growth for 5 straight years? Top 3, 5 straight years. And all that growth means a much larger airport. And that growth is directly tied to logistics, warehousing needs, which is really what's driving the demand for flex industrial product near the airport. And that's where we are. Also, Utah's incredibly strategic location and its very strong rail and road infrastructure means that providers like Amazon are choosing Salt Lake City as their regional location for fulfillment. Amazon's building not 1, but 2 brand new jumbo fulfillment centers. And that's acting as an incubator for a high variety of logistics and fulfillment businesses, which are just popping up all over the place. And they're really driving the demand for flex industrial. It's also driving demand for jobs. For instance, Amazon's West Jordan facility announced last week that they need to fill 1,500 full-time positions ahead of the opening of their 2nd location. And Google's no slouch either. Google's cloud data center, it's huge, opened in Salt Lake City only 4 months ago. And Facebook is also looking to up the ante. Its massive $1 billion Eagle Mountain data center hasn't even opened yet, and the company has already announced plans to expand it by 50%. That's over 500,000 square feet extra. Now, Utah, because of its position between Mexico and Canada and both east-west and north-south interstate connections, it's a really critical checkpoint for cargo, and it has the potential to enhance supply chain connections, particularly for trucking. In a post-COVID world, supply chains are so much more critical. And that's why Utah's location is so key, because it can support multiple trade lanes coming from different places in different directions. And this new trade port is going to completely turbocharge that ability that Utah has. This map really drives home the reason why big companies love putting locations in Utah. So logistics and trucking companies, they look at an 11-hour trucking zone. You see this zone here in yellow, and a 22-hour trucking zone. You see it in light blue here. May not be very visible on your screen. So Salt Lake's trucking lanes can touch San Francisco and LA and Denver in 11 hours, which is standard trucking day, and can touch everything in the Western United States in 22 hours. And it can do that at a much lower cost than running trucking centers on the West Coast. So in the end, it really all comes down to dollars and cents. And this slide for me, it really brings it home. There's now no doubt that Salt Lake City is becoming a first-class metro for all kinds of investments. While we are talking about flex space today, not multifamily, we all know that population growth and household formation drives e-commerce, it drives warehousing activity. So for 1 minute, I want you to take a break from flex industrial. Look at this chart. This really proves how little the impact of COVID has been on Salt Lake City. This chart shows the price per unit for multifamily. As you can see here, this price per unit was about $170,000 last year. But in the first 5 months of 2020, this price per unit has spiked to an astonishing $249,000 per unit. And please remember that 3 of those 5 months were the headliner months for the pandemic. This is how strong Salt Lake's economy is today. And it is our belief that this strength is going to endure, and we're going to reap the profits over the next few years. So let me finish off my section by walking you through the micro neighborhood that we are investing in. Let's start with the most powerful number, which is income. 78,000 in median household income is just a terrific number. Most of our multifamilies are located in areas with 40 to 60K income. Equally important is that this neighborhood is composed of white collar workers. As we know, COVID's been a blue collar recession so far, which is why this white collar neighborhood has an extremely low unemployment rate. In June, the unemployment rate in this neighborhood was 4.7%. Compare that to the national unemployment level at 11.1%. So it's no surprise to see that the area has very high home ownership. Only about 16% of the people living in this neighborhood rent. Those strong numbers obviously lead to price increases. So home prices have increased by 8% over the last 2 years, and they should keep increasing because there are now nearly 300,000 high-paying jobs within a 30-mile drive of the city of Woods Cross. All in all, we are absolutely investing in a white-collar, low unemployment, high-income neighborhood with very strong growth potential. So now I'm going to ask Rich to walk you through the project itself.
Yeah, thanks. Yeah, it's fun to watch these numbers back and forth. I love where I live and I love where I develop, and it's fun to hear input from you guys on this. And there's some stuff I know that I can't share on a group chat like this, but you're going to see some additional growth quite a bit here in the next little while too. But as you look at this map, you can see we're in a perfect location for our industrial flex, sitting comfortably between the residential neighborhoods on our left, which is west, and more traditional industrial area on the right, which is east. And then just outside of the picture to the right is that I-15, which Neil talked about giving access to every major city in the Mountain West and quite frankly in the US. So from this site on the I-15 on-ramp, we're only 7 minutes away. And in I-15, again, from Salt Lake City, if you go south, it'll take you down to San Diego. If you go north, it'll take you all the way up to Canada. And then I-80 is only about 12 minutes away from our site, which takes us west to San Francisco and east all the way to New Jersey. So we're literally in the crosshairs of a major freeway system, giving us access to the country in any direction. I bought this land about 2 years ago, almost actually to the month. It's been 2 years, and we're actually finally now ready for development.
Yeah, Rich, I wanted to just emphasize this point to our audience. This land has been owned by the development team for 2 full years. And during that time, the risk that was taken for zoning, for permitting, the money that was spent, it was not at the investor cost. We're inviting you in when all of that is done and the project is ready for construction. Most of Grocapitus's construction projects are not this shovel ready. For example, our Mesa project is going to be shovel ready in September, though we took phase 1 investor money in December last year. So that's really a key differentiator for this project.
Yeah, that's a great point. We actually had countless iterations with the city. In fact, we even designed this entire facility twice. So we had 2 complete sets of drawings, and then we created a brand new secondary access, did all the environmental studies and everything, and finally got to the point where we're about to pull permit. And that's obviously why we're now inviting you to come along. We've worked our tails off to secure this property. And some outdoor storage space. And we've created these storefronts on the buildings closest to the charter school that was there, as I said, on the west. So it's a really nice storefront look, but we've made these buildings extremely efficient, really focused on and being cost conscious and focused on creating a very noteworthy, flexible space that nearby residents could feel proud of and excited about. And then, of course, we have more parking than is required, and all that because in the back of our minds, we're always thinking about who else could lease this space and be here at this location. As you look at the actual building itself, it's a classic structure with lots of windows so that we can enjoy all the mountain scenery and bring as much natural light as possible. All the while, our focus has been to keep costs tight, making sure we're not over designing the space so that it's accessible to, like we said, startups who are just getting going, but there's still a desired spot for institutional tenants as well because of the ability to expand and grow. And then we always design for our renters to have a place that they can be really proud of. It's a nice workspace and gives them the ability to receive, large shipments with big overhead rolling doors, all while, again, having that kind of nice storefront feel. The method of construction is one of my favorite methods, especially in the industrial space. It's called concrete tilt-up. So it's really, we feel like kids, playing with big Lego blocks because we form the walls on the ground floor and then pour the concrete and then actually tilt those forms up with these large cranes, as you can see here. It's a great, quick method to build. It also helps us finish the structure faster and provides investors, of course, a faster return on their cash, along with the efficiencies and sustainability that goes along with the concrete tilt. There's also a huge benefit in utility costs because of the efficiencies of this construction. It makes it more attractive to potential clients to rent. We have around the surrounding areas near our building are a few other competing products. And in the market that's growing so fast, we don't anticipate a lot of difficulty in leasing our space. As you can see, most of these buildings are a little bit older than ours, but and because they're older, they don't have the benefit of the taller, more fluid space like we have. But the only asset that's really as strong as ours is the Sky Park Flex on the top left. Their location's a little bit more difficult. It's not as ours. It's right by a freeway overpass and near kind of some swampy farmlands. They did a beautiful job on the construction, just the location's a little different than ours. As you can imagine, and as we look at the rental comps, we fall right in line with that Sky Park Flex, which is a newer development. But as previously mentioned, it's very well built, but the space is limited. They've almost been completely leased out. And even though, again, it's a great project with amenities very similar to ours, their site has very little access to the mountain views compared to ours and sits, as I said, close to the freeway. So you'll have to deal with some of those additional noise and debris.
Yeah, and Rich, I wanted to highlight that orange bubble on the bottom left. The vacancy in this area for our size of buildings is under 4%, which is really very key for us when we look at new projects, especially new construction projects.
Oh, that's great. Yeah, that's a fantastic point. I think, well, as you look at this chart, it's a little complex, but really what it's saying is the overall vacancy is extremely low. And that sweet spot is really that smaller to mid-size unit. Those tend to have more demand and of course, less supply. And that's exactly what we're building. Our goal was to build an asset that would house the Amazon supporting staff. We have buildings starting at 15,000 square feet and move all the way up to 60,000 square feet in the buildings. And then we also have the ability to demise walls to allow for potentially smaller users as well.
Yep.
Oh, go ahead.
Yeah, sorry, go ahead.
Oh, you're fine.
Sorry, Rich. I think you forgot to mention that monster Amazon location
12
is
miles
just down the road.
Which, in Utah time, it's only about an 8-minute drive. I know in California, 12 miles is a long way, but in Utah, it's less than 10 minutes. So one of the more exciting things about our project is actually the sales comp data. As you can see in this slide, the average price per square foot of competing projects sell on average about $181 per square foot, where our exit numbers are based right around $144 per square foot. And we feel it's conservative, and obviously just want to highlight that. Our goal is, as the old adage goes, to under promise and over deliver to investors on our projections, and we believe that this is what we're doing on this project. So as you look at the business plan, you can see we're only a few short months away from starting our offsite improvements. The lenders agreed to fund any pre-leasing building plus one, any pre-leased buildings plus one spec building. So this is, as we talked about, having 50% pre-leased before you even start construction or build to suit. We're falling right in line with that. So we have we've staggered the build times to in the business plan to allow time to acquire leases and then build. So we already have a couple of LOIs for 2 buildings, so we're off to a great start. In fact, as we get construction going, the construction of the concrete tilts about 6 months, and then we move to the tenant improvement phase, which takes anywhere between 2 and 4 months per building, depending on what the tenant requires. And after we do the tenant improvements are complete, they're finished up, it's typically about a month or 2 before we start seeing rent from these industrial tenants. So in a 12-month period, we're looking to be built, improved, and leased with rent starting at about month 14, roughly. So Neil, I'll pass it on to you to wrap things up.
Sounds good. Yeah, it's fantastic to see that super short construction schedule. All right, let's end this presentation with a little number crunching. Take a very quick look at the financials of the project. Here's a summary of our exit options. We're using loans that give us a lot of options. So our default option, which is the one in green, is the 3-year hold. We're going to lease up, wait a year, and then pay off the construction loan at the time of sale, which should be sometime in the 3rd year. We conservatively use 36 months, but we could actually exit in 2 years potentially if we hit our goal for returns. And speaking of returns, we project net returns to investors of 66% over 3 years. So annualized simple returns are 22% a year. I prefer to look at IRR returns. So those are over 20%, very, very healthy. Now, if we decide to hold for 5 years, if the cash flow is strong and the market's going up and the investors want to stay in, then we will refinance at the end of year 3, pay off our construction loan, and then hold for 2 more years. In this case, we're projecting that we will double your money over 5 years, so our equity multiple is 2x. And in this case, the IRR increases to almost 22% because that refinance in year 3, it boosts returns. And if things are really going well on the cash flow side, we may choose to hold 7 years instead of 5. This option is very similar to the 5-year option, only we're projecting that a $100K investment turns into $236K in 7 years, at an IRR of about 19%. The key is that all of the options project strong cash flow. So we're quite happy to take feedback from investors as we go and stay flexible. Okay, now let's look at the financial highlights. The management team are investors in the project too. We're investing $500,000 of our hard-earned money into the deal. So that's almost 8% of the total equity. Most of our deals tend to be closer to 5%. The loan is about $19 million, which means that the total project size is about 200,000 square feet, about $25.5 million. We are raising $6.4 million minus the $500,000 that comes from the sponsors. So $5.9 million is our raise. The minimum investment is $75K, though investors who invest more 100K or more will have first dibs to the shares. We do expect this one to go very quickly. First-time investors with Grocapitus can ask to be placed on standby if they only want to invest 50K, so we can put you in standby status. In terms of fees, we're charging a 5% developer fee. Note that's on hard costs only, not on the entire project. The asset management fee is 2% of gross collected rents. Now, this is a 506C offering, so accredited investors only. We're offering investors an 8% pref or preferred return. And if you don't know what that means, just ask us during the Q&A session. The profits are split 70-30 between investors and general partners after taking care of your 8% annualized pref. There is a small bonus for the partners in that once the annualized simple return to the limited partners exceeds 22%, this is going to be calculated at exit, then the portions of profit above, only the portion of profit above that 22% a year, that's now split 50-50 instead of being split 70-30. So it's a little spiff for us for overperformance. Let's finish by looking at the projected cash flow. First year, we have no cash flow. We're in construction. Cash flow starts in year 2, and you can expect around 13% cash flow in both year 2 and 3, with sale occurring at the end of year 3. So that big chunk comes on sale. So it's really great for those of you that have big W-2s and you know the huge difference between ordinary income and capital gains taxes. It's also great for retirement account investment people because you can't grab that cash flow anyway. So it goes back into the retirement account. Bottom line, we're projecting over 22% simple annualized returns for you based on this 3-year exit model. This page shows the cash flow if we decide to refi at the end of year 3 instead of selling the project. Well, year 1 and 2, same as before. Year 3 is slightly higher at 16% because now you're getting some of the proceeds from that refinance. Year 4 and 5 are strong at around 11% each. This is the option that's projecting that we will double your money. So 20% simple returns, 21.74% IRR. We've also included cash flow for the 7-year option. Here you can see on the top right, the projected cash flow continues to increase in year 6 and in year 7. And that is everything that we wanted to tell you about Woods Cross. We know that many of you have questions, so we'll take questions at this time. We are putting up a poll, so it's absolutely critical that you let us know about your interest by answering the poll. Please answer the poll now. I have it coming up. There we go. It's up on your screen, and we'll leave it up while we take questions. We're also going to put commonly asked questions. We're going to put some of those up on the screen as well.
Rich, Neil, you ready?
Yeah.
Okay, before I get started with the questions, I want to remind everybody that I am going to be taking questions from the Q&A box, not the chat box. So if you want a chance of having your question answered, please put it in the right place. Let's start out with a common question. Are you going to do a cost segregation study?
The answer is yes. For those that don't know, cost segregation studies help us deliver paper losses to investors, which helps offset their other passive gains. So a lot of our investors care about that a great deal. The answer is absolutely, we'll be doing a cost segregation. But keep in mind, because it's a new construction project, it probably won't be in 2020. So that cost segregation is probably going to happen towards the end of 2021.
Okay, I've got a twofer for you. What is preferred return? And then somebody who understands preferred return says, will the preferred return be paid in the first year?
So preferred returns come in different varieties, but this one's straightforward. Let's say we do a 3-year project. If the pref is 8%, this means that 8, 8, and 8 for the 3 years goes to you. Actually, the pref starts on occupancy, correct?
No, the pref for this project starts at close of construction loan or completion of the raise, whichever is last. So basically, from the beginning
it's starting
of the project
now, right? So it starts at the very beginning,
which is
so if
amazing for a construction project. By the way.
Exactly. So this is an early pref. Some of our other projects, the pref really has started when the construction was done. So what that means is if it's a 3-year project, you're due 8, 8, and 8% for each of those 3 years, which is a 24% return before we can touch any of the profits. We don't get a split until you get your 24%. That's what the pref means in this instance.
Okay. Are the developer and asset management fee annually or one time?
The developer fee is a one-time fee, and that's pretty standard. So not, the percentages are pretty standard in the industry, and also the fact that it's one time is also standard in the industry. Asset management fees are a much, much smaller fee than a developer fee. It's a tiny fraction of what a developer fee would be, and it is an annual fee because we're managing the asset. We're spending time.
It's a monthly or quarterly fee, not an annual fee.
Yeah. So 2% on an annualized basis, though, correct?
Correct, but the asset management fee only starts when there are actual
Tenants,
income.
yeah.
So there's no asset management fee the first year.
That's right.
Let's see. For the 5-year plan, why is the return lower for year 4 and 5?
Because when you refinance and give money back to investors, you're taking a larger loan. So when you take a larger loan, it's beneficial to lots of parties. Remember, in year 3, you did see a higher gain. So there's a lot of benefits of that refi, but when you take a bigger loan, you have a bigger payment. So it takes a while for your interest payments to build up again. Sorry, not your interest payment, your cash flow payment to build up again.
Who or how is the decision to sell in year 3, 4, 5, or 7?
I think it's a joint decision. Rich is the expert in the marketplace. So,
Yeah.
Rich, what are your thoughts on this? I mean, why would we want to sell in 3 or 5? What do you usually look at when you're making that decision?
It's a great question. My experience has been in all the real estate I've owned, I don't generally put it out to market to sell unless we're looking to exit that specific area. But considering where these are, I think at this point it would be, if the number makes sense, that if we maximize that value, meaning if we were to get a 2x return on a specific building, if we were to carve that out and say, hey, we're going to get a full 2x return in year 2, it would make sense to sell that rather than trying to maximize out and try and get a little more than 2x by year 5, just because of the time value of money.
Right. So sometimes the market's really going fast and you're getting most of your return anyway, then it makes sense to sell because it could slow down. And in any case, if it's going fast, it can't stay fast forever. So it's really about where you stand and where that market stands, where we see the market being in the next year or 2. But our goal is to exit in 3 years. And give you those returns. There are a number of scenarios where we might choose to say, you know what, this is going to keep going up. We feel very strongly that this is going to keep going up. In that case, it makes sense to hang on for another couple of years. The 7-year scenario is the least likely of the 3.
Yeah, and based on that, there's several people asking if we are offering 1031. We are not offering 1031 for this project. It is not 1031 eligible for various reasons. One of which is that it could be a very short-term project.
Yeah.
So it is not a good fit. We have several questions, Rich, we're going to throw at you. So what is an average leasing term? How many years do tenants sign leases for?
That's a great question. A lot of times it depends of course on the tenant, but I don't know that it makes sense to sign anything less than a 5-year lease. I have looked at 3-year leases, but usually what we do is with a 5-year lease, preferably a 10-year lease, with options after that. And then on each lease term, you have it increasing by 2 to 3% annually with those little rent bumps, so that you're staying on top of the inflation.
Okay, who is in the leasing pipeline for the project, and what is the risk if the property does not get leased up?
That's a great question. We actually have, this is one of these things that it's fun to answer, but it's also tough to answer. We have, up to this point, we have 38 serious inquiries where brokers have reached out and asked for an LOI or a proposal. And we haven't gone that far yet, simply because we wanted to make sure we had everything through the city, which we now do. So now we're starting to get serious about taking letters of intent and considering options to lease, where before we weren't ready to tell people, hey, we're ready to start taking lease options and LOIs, simply because we were working really hard on getting that secondary access approved and finished up. And now that that's done, we have our final meetings with the city. Everything's been approved. Now it's just more tweaking the site plan and tweaking the building designs.
Rich, I think it's worthwhile to go a little bit into that secondary access. I mean, you just mentioned it now. So talk about what the city threw up as that obstacle, and what are the timelines around, it's a long time that this project's been trying to get going. So what's happened?
And it's all to do with that secondary access.
That's right.
So as you go into the development, you'll see currently that there's only one access in and out. And we actually went through many DRC meetings with the city, with the fire department. And it wasn't until our last DRC meeting that the county fire department said, hey, we're not comfortable with, if there's a fire in one of these properties, we want to make sure we can go and put the fire out. And to be able to turn a fire truck in there with only one access and people trying to vacate if there is a fire or catastrophe, they want to have that secondary access done. And so we started negotiating with the neighboring property that actually has a line that's already designated for that secondary access, but hadn't been condemned. I know condemned sounds like a bad word, but the city hadn't actually taken control of, but that was in the plans at all times. They just hadn't taken control of that. So they finally ended up taking control of that. The secondary access is now in the plans. It's not complete, but what the fire department did was approve a temporary fire emergency access that's on the lower end of the project. So if there were an incident there's a temporary access for emergency only that would vacate into or dump into the neighboring neighborhood. And that was really kind of the holdup, but now we've got that handled and ready to go.
So which buildings are the two LOIs for, and what type of tenants are those?
Yeah, the two smaller, one's a construction company and the other one is a med device company. So they're both the 15,000 square foot buildings. Again, we didn't want to get too far ahead of ourselves on any of the development or committing to anybody, because what you'll find, and what's interesting, especially in the space that we're in industrial, is a lot of times people want to, when their lease is up, they start looking for new spaces to go to, and they're not considering 2 years down the road or 18 months down the road. They're always looking like what's available in the next 6 months. And so that's why with our strategy, we didn't want to get, like we said, too far ahead of our skis and build all 6 buildings and just wait for people to lease. We'll always have one that's all fully leased, ready to go, and then one spec build. And then as we build that spec, and once that's leased up, then we'll start construction on the second one. That way we reduce our risk of overexposure to the market and building faster than the market can absorb.
Yep.
Could you discuss the construction loan in more detail? This kind of feeds right into what you were just describing.
Sorry, describe the construction.
The construction loan in more detail.
Oh yeah, so the construction loan, we're approved with actually the University of Utah Federal Credit Union. They're really pretty excited about this project, and the plan is to any building that's already leased and signed and agreed to, we will go and build as soon as the design plans are done, and then after that we will build one spec building, which means what we'll do is we'll do all the perimeter and the exterior, and then leave it available for someone to come in and say, hey, I want, in this 30,000 square foot building, I want 20,000 square feet. What's it going to cost for me to do a demising wall and take this 10,000 square feet? And so the way we've designed these buildings is that we can actually break it up into several different projects so that we're not, pigeonholed into only one type of tenant.
Okay. What is Rich's role going to be on the project going forward? Is he exiting the asset? And then I'll tag on to this. How many people on the GP team, and who are the GPs?
Well, all of the GPs are present at this point in time. So Rich is not exiting the project.
Yeah.
So
Nope, I'm excited about it.
Rich is building the project for us. We're going to be working very closely with him, but there's nobody exiting at this point in time. No. And there's actually nobody planned to exit. So Grocapitus and Rich are working together on the project. So you've got all the GPs on the call.
Yeah.
Go ahead, Rich.
Oh, sorry. I was just going to add, it's funny. Whether or not, I don't want to get ahead of myself, but I opened up one of the Q&A things, and I've seen the question a few times about the earthquake resistance of the construction.
Oh yeah.
Method.
I'll scroll up. There's lots of great questions. We've got 84 open questions. So yeah, that's a good one. Why don't you go for that earthquake one? That was a good one.
Yeah. So if you start to
repeat the question so everybody knows what you're answering, please.
Yeah. The question is, how earthquake resistant is this type of construction method? Because I think mentally, when you think concrete tilt, you're just pouring concrete and tilting it, and then if there's an earthquake, it all shakes and falls apart. But I would challenge you to look at, in Christchurch, New Zealand, there was an apartment complex that they actually built out of concrete tilt. And I don't know if you remember, but about 10 years ago in Christchurch, New Zealand, there was a devastating earthquake that demolished the entire city. And that building was the only one remaining. And that's because of the method. So if you were to watch the concrete tilt up happen through the process, it's so reinforced with rebar. The amount of flex that's in those buildings is actually awe-inspiring. Sometimes when you get a really tall tilt, we can tilt something as tall as 40 feet or 50 feet. You can actually see the wall. If you see my head, it actually bends when the crane's lifting it up. And then when it gets to the top, it straightens out. And so it actually has that flexibility to go because it's all reinforced with rebar. It's more rebar than you would ever see in any project.
Wow. So what does the pipeline for additional flex space in Salt Lake City look like? Is there lots of new construction coming near term?
Fortunately and unfortunately, no. Fortunately for us, no, there's not. Unfortunately, there's going to be a lot of need for that type of product that the state needs desperately, because for a smaller company that's looking for 5 to 10,000 square feet of that type of space, your only options are literally buildings that have been built in the 60s and 70s. This med device company, I was actually just at their offices today, and the entire building was built in the 60s. And I mean, it's as bad as you could imagine it would be. So they're thrilled and excited to get under construction as soon as possible.
Is the IRR gross or net of fees? We had a couple people ask about whether the projections are net of fees. And so the answer, go ahead, Neil.
We never show gross numbers in our calculations. They're always net. So all the numbers that you've seen today are net, and any fees and any splits have already been taken out.
Okay, and there's also quite a few people asking about monthly or quarterly distributions. How do we do distributions, Neil?
So quarterly distributions are the most likely. I think that we've had feedback from investors sometimes about monthly distributions, but we find that tends to irritate our property managers and create logistics issues. So we distribute quarterly.
Let's see. Talk a little bit about the triple net leases. We still have people asking more about the leasing information. What does that mean? Explain that for people.
Rich, you want to take that? Triple net?
I'm sorry, well, I missed that question. What was that?
Will there be long-term tenants and triple net leases?
Yeah.
So if you could talk, we've already established there would be long-term tenants. Could you talk a little bit about triple net leases and what that means?
Oh, did we lose Rich?
Maybe.
Yeah, I think we
Copy.
Oh, I think you're freezing, Rich.
Yeah. Or he's just looking at us very intently. No, I think it froze for a second there. So I'll take that question. So when I was in technology, we'd basically rent out flex space. So, our company, for all of its, 16 or 17 years that I was part of it, was in a flex space. And so what triple net really means is that the tenant is really responsible for everything. Taxes, the tenant's responsible. Insurance, the tenant's responsible. Maintenance, the tenant's responsible. Something happens to the, fire, to the sprinklers, and all the grass burns down, well, tenant is responsible. So net, basically triple net came from the word net, right? So when we're receiving, rent that's coming in, it's basically net of costs, because it's the tenant's responsibility to pay those, including the property taxes. Sorry, Rich, you froze there for a few seconds.
Yeah.
Yeah, no, I saw that. I was responding and everything stopped. So I apologize. Thank you for taking that. That was a perfect explanation.
Is there any markup on the land, or is it price plus cost? Talk about the land price for the project, please.
Yeah, so it's actually less than market value, simply because we bought it a couple of years ago and spent a lot of time building and getting everything through the city. So we bought it on pricing about 2 years ago, and there is no markup on the land. This land is being brought in as it is, as the current value.
Rich's projects are mostly multifamily. What are his completed projects in flex? We've had a couple people ask about your experience in developing industrial in flex.
Oh yeah, actually, I would actually argue the opposite. Most of my experience has been in the industrial space. It's multifamily has only been, I only really forayed into multifamily about 5 years ago when I first started making acquisitions in the multifamily world. And my first acquisition had a development component to it. And so we bought an existing project, developed additional units. And that was when I saw an opportunity, especially in the growth in the population in Utah. And so all the assets that I had bought outside of the state, we started disposing of those and focusing more on Utah, simply because, again, the market, none of the information that was shared today was a surprise to me, but it was always a little bit surprising to say, gosh, it's crazy, because this is the world we live in, that we know the market's as good as it is. That statistically, the economic plan, a letter from the Kim Gardner School of Economics shows that we actually anticipate the population to double over the next 19 years. And
That's crazy.
I mean,
I
it's
believe
nuts.
Utah's the only state that will double over the next 20 years. So
That's
Utah
exactly
County
right.
is more than double, right? So it's
That's
completely nuts growth. It's just ridiculous.
Yeah, I've been looking at Utah County land, and it's pretty wild. Anything, I mean, we've just been benefiting a lot from a lot of people vacating more populated, more dense areas to Utah simply because of the work-life balance as well as cost of living. But you know, as we're seeing 8% increases in home values, I don't know. The cost of living seems to be going up.
Can't go on forever, right?
Yeah.
No, sadly.
What's your lease operation to ensure the high occupancy? Who does the lease? Is it Grocapitus?
Oh, no, there's a property manager. We actually, a couple minutes ago, we had the property manager on the screen. So we're paying a property manager to do our lease ups and also
I believe the lease ups are not being done by the property manager.
That's right.
Lease ups
It might be CBRE.
By Colliers.
Yes.
Colliers. Okay,
Yep,
sorry, I had
Colliers.
that wrong. Yeah,
That's
sorry,
okay.
I messed that up.
So that's okay. We do actually have a property manager as well that helps negotiate and manage the asset, but it's Colliers that's doing all the lease up, and they've done a great job for me on multiple other projects. One of I can give you dozens of examples, but they're a fantastic team, and actually the largest, most active team in Davis County.
So I know I can't seem to find it now, but I know somebody was asking, they were suggesting that Flex Industrial was management intensive and compared to multifamily. What's your opinion of that?
Oh, no. No.
That does not sound right. That does not sound right at all.
Yeah, that's just the opposite. We literally, because it's a triple net lease, they pay taxes, insurance. I mean, really all you ever really hear about is if somebody's lawn hasn't been mowed. That's most of
You still have to keep an eye on them. I don't
absolutely.
think, it doesn't run in autopilot, but I could not possibly imagine having the same overhead as multifamily. No.
Yeah, the management issues, and you just have a lot more, personalities in the multifamily world to deal with than than you have in the industrial
Rich is
space.
being kind.
Yeah, and we do have a question on commissions, if we're paying commissions on lease up, and the answer is yes, and that's already built into the underwriting. So that's all.
But we're not paying commissions to ourselves. So we're paying commissions to Colliers.
But that's all built in. It's all into the underwriting. So let's see. Will we have a surprise if we run a background check on Rich Day, since he's been building several projects?
Ooh, that's a good one. That is
a good one. That's a great question. No, you're more than welcome. More than welcome to check into my history. It's good. I think, I don't know, unless something I don't know about.
We don't like to get political, but this seems like a very specific question that could be an interesting one because it's related to Utah 4th District. How can the 2020 presidential Utah 4th District election affect construction of this project?
I don't know specifically what.
I mean, that would be for Rich. I don't know who's.
Yeah, I don't know the specific question or how to answer that exactly. I know politically we've grown, and regardless of who's in the head office here in Utah, the current Governor Herbert has done a phenomenal job by way of bringing additional business and exciting businesses to come to Utah. And so his Lieutenant Governor Cox actually won the Republican nomination. And here in the state of Utah, we're very very Republican most of the time. So I think it's one of those things that we won't see a big difference in any political movements or move. Salt Lake City and Salt Lake County is a little more on the liberal Democratic side, leans a little more left than the state does. But here in Davis County, it's very much consistent with the way it's been for 40 years.
And I also want to emphasize this is my 5th project in Utah, and they're very tenant friendly. Very landlord friendly. They're very business friendly, and I think that's just part of the culture here. I don't think that a election in any one district is going to change the way that they think about business.
If you refinance in 3 years, will there be a payout from the refinance, I guess, to the investors? I can actually answer that one. There would be a very small payout. There'd be about $300K that would be distributed to investors. But we're not trying to pump up the project by giving the investors a large amount of money back. We're just trying to do the minimum just to be conservative. So it's a 65% loan to value. at 4% interest rate, and just 300K is left over. So that's what boosts it up. And the investors are projected to get 16% cash on cash for that particular year. But sometimes some projects you see a really gigantic number. We were trying to be very conservative.
Yeah, I mean, you can put any number in Excel, but the honest answer is I'm not sure that these refinance numbers that I'm seeing recently are reasonable, given that banks are being, tighter. So, we just simply wanted to refinance the project so that we could continue giving you cash flow. Honest answer.
Yeah. So some people are a little confused about the 3, 5, and 7. So do I have an option to exit at 3 years, irrespective of how long this project stays? So if we were to go on for 5 years, could somebody exit at 3 years?
No, it definitely is not designed that way. We gave you our thought process. We may exit in 3, we may exit in 5, we may exit in 7, but you're all along with us for the ride. The dominant option at this point, I'd give it more than a 50% chance, is the 3-year option. I'll give the 7-year option maybe a 10% chance. So you understand what it is that we're looking for. We want that flexibility of exit, so we want to talk with you about it. But we think that something has to go wrong for us to not exit at the 3-year mark.
Will I be able to 1031 exchange this investment at the time of its exit?
We don't believe so. It may be possible. We certainly won't say no. Sometimes that is possible, but I think that the likelihood is small.
Yeah, everybody would have to want to 1031, and it's very unlikely to do that with a normal syndication. How high are those loading dock doors, Rich?
Oh, they are, I believe on this, I think they're 20 feet. I'd have to go back and confirm, but I can get that back. I don't know.
You're gonna get a full-size truck in there.
Oh yeah, absolutely. Absolutely.
And by the way, that the answer to that is in the investment summary. So,
Yeah.
There's lots of details in the investment summary, which will be going out with the docs. So if you had indicated that you are interested at some level versus not interested, you will receive the links to the docs and get our very glorious and fully detailed investment summary along with a PPM.
Yep.
How many tenants will be needed to achieve 100% occupancy? And then somebody else was saying, like, how many tenants do you expect you'll have? Like, those kind of go together.
100% occupancy requires 100% of the tenants,
Well, yeah,
but maybe it's chopped up, right, into multiple pieces.
So the way that we've designed the building is so that you can devise the project. So on that 15,000 square foot building, we actually can devise it into 3 5,000 square foot facilities. So in that one building, you can have 3 separate tenants. In the next building over, you could have 6 separate tenants. So really, we've done demising walls so that people can have the option for, smaller tenants or larger tenants that want to take the entire building.
But Rich, I mean, just speculate, if you've got 6 buildings in a kind of middle of the fairway scenario, do you think we'll have 10 tenants? We'll have 15?
That's probably, I would say between 10 and 15. I think 10 and 15 it would be the max. I know that, for example, this med device company I was telling you about, their current space is about 7,500 square feet. They're looking for 10,000, but they said, hey, we might just take the full 15,000 square foot project, which is where the LOI is. And then they decided that if they want to, they can sublease the last 5,000 square feet on their own, but they would be the master lease on the project.
Got it.
So there's a general question on here. What is the major risk for this project? We have several people saying, sounds good. What is the major risk on this project?
My feeling would be the major risk would be just lease up. I think whether or not the market can absorb, but it's not. It's only 200,000 square feet. So in my mind, the major risk would be lease up. We already know the construction costs. We actually are finalizing the construction agreements with the contractor to sign what's called a GMAX contract, which is a general max contract where anything over their max budget would actually be absorbed by the contractor. So we as the owners wouldn't be at risk if the builder said, oh, it costs 20% more than we thought. And we say, well, sorry, you signed the GMAX contract that said, you're obligated to pay those additional costs from your budget. So outside of that, I can't think of anything off the top of my head that would be major risk. It would just be lease up.
Yeah, I think so. Obviously, any market can change. but given where we are with e-commerce and kind of its ongoing run, I'd say that 90% of our risk is lease up and maybe 10% is in the construction. I mean, multifamily is much, much harder to construct than tilt-top, industrial. So I see very low risk there. The other big risk, which people talk about all the time, they're afraid of it, is the zoning, the permitting, the city approvals. And here, that's already been taken care of.
Is there any issue in investing with Roth IRA?
I don't see an issue, no.
Yeah,
No.
yeah. I'm not on that side of it, but in other deals I've done in the past, direct IRAs are great ways to go. Actually, a lot of people like them that way.
Let's see. How much money are you needing to raise?
We're looking to raise about $5.9 million. I think that when we get to, a smaller amount than that, significantly smaller than that, we'll trigger the raise because we're pretty confident there's a lot of interest in this type of project. This asset class is getting a huge amount of interest. So I think that when we get to about 3 or 4 million, we're going to trigger the project. But I think the total amount that we need to raise is 5.9 million. Some of that, quite a bit of that is developer fees. So, about 5 million, give or take a little.
Do the LPs get 100% of the depreciation?
No, the depreciation is split between us and the limited partners, so you get 70% of it.
Is the pref a return on capital or a return of capital?
Well, that's an Anna question. How did we model this?
It's return on capital.
On capital. So
pref
it is
return
actual
on
return.
capital. Yes.
Okay.
Where is the money paid for the land in the capital stack?
I'm not sure how exactly to answer that question, Anna. Your thoughts?
So the land, we raise the money and
the money. The first thing we're going to do is buy the land. Essentially, it's being bought from us by us, but we still need to compensate ourselves for land that we've held for 2 years.
Yes. Let's see. Is the 13% return based on 100% lease up by year 2?
I don't think it's 100%.
Yeah, by year 2.
By year two.
Yes. Yeah. So it would be 100% leased up. Remember, we can't build until we lease, right? Except the one spec.
Exactly.
So it's
build, lease, build, lease, build, lease. Yeah.
Yeah. No, lease, build, lease, build. You have that backwards.
Lease, build, lease, build. Yes.
Yes.
That's
Pre-lease, build, pre-lease, build. Okay.
Yeah.
Do you do cost seg and give bonus depreciation? If so, how much?
Well, whatever the accountant allows. Bonus depreciation is really no different for one asset class to another asset class. Whatever is allowed by the CPAs is what we'll be handing out. But my understanding is bonus depreciation works the same way for multifamily and industrial.
Who's going to be the property manager? You've got a slide on that, Neil.
Yes, I've got one. I'm going to pop that up while you take the next question.
What is the timeline to commit the investment?
Well, I mean, the honest answer is the sooner the better, simply because it is it's one of those, first come, first serves. Once you commit and you sign docs, we will give you time to bring in funds. We're not super, in a hurry on everyone's funds needing to come in quickly. So if there's an issue, for example, if you need to put funds into IRA, we'll give you more time on that. The key is docs. And if for some reason you have to back off, after you sign docs, don't worry about that. We're not aggressive about that.
What are the % operating costs of the project, and how does that compare benchmark numbers?
That's an interesting one, right? So
yeah, but the thing with triple net is that the operating costs are going back to the tenants.
Yeah.
So in the way that we underwrote it is that 97% of the operating expenses, including, there was an earlier question by Lena about who pays the property insurance and that type of stuff. Well, it's the tenant. It's a triple net. That's how triple net works. We underwrote it that 97% of the operating costs are going back to the tenant. But Rich was saying, oh, it's really 100%. But we're like, no, there's got to be, I don't know, some common area or something. So just to be conservative, we use 97% instead of 100. Right, Rich?
Yeah, I think that's great.
Yeah. So operating costs aren't really a thing. That
No, you have CAM fees. So for utilities and that you charge back to the tenants, and then of course property management fees. I think obviously
even the property management fee the tenant pays, which is
yes.
crazy compared to multifamily.
Yeah, I've never
The
understood
owners.
that, but the
Yeah,
PM
but
fees are actually
the
being paid
PM
by the
fees are
tenants.
actually being paid by the tenant.
Yes.
Yeah,
You guys have
it's
a
a lovely
really good
world.
scam going in industrial.
Industrial is a good spot. I can't argue it.
Yeah. Is the GP taking a fee for the refi in year 3?
No.
No. Let's see. So many 1031 questions.
Rich, we
Let's
need
see.
1031 projects. What else you got?
I've got some others I'm working on. So
Who usually purchases this kind of asset class when you exit?
That's a good question.
REITs
Yeah, I
or
love that.
institutional investors?
Yeah.
yeah, a lot of times institutions love industrial, especially right now. But a lot of times, in fact, I just sold a big industrial project about 3 weeks ago. And it was a high net worth individual who had exited out of a multifamily project that had 1031 money and was looking for the simplicity of industrial flex.
And Rich, do occupiers sometimes end up becoming owners?
Very much so. Yeah. In fact, the way that we had talked about this with the city is we actually talked about condominiumizing some of the units to where the people who came in could actually buy the units themselves after they occupied it. So that's an option for us if we want to consider it.
Let's see, who's the builder contractor? So now you can change to that other slide.
I'm ready for
I
this.
told you, I said we should leave these slides in. People are gonna,
Rich wanted to put the STOUT slide in, but we didn't want the presentation to go too long. But STOUT's really well known. I've been to their office. Really good people. I mean, look at how many states they've built in. So this is a very strong company.
Rich, do you want to speak a little bit about your experience with STOUT?
Yeah, so the STOUT construction, as you can see, the primary thing they focus on is industrial, and that was a big pull. They, I've known STOUT for many years. In fact, he actually lives just probably 30 minutes away from me. Well, that's not true. It's even closer than that. He probably only lives about 15 minutes away from me, but 30 minutes away from the site. And they've been building for 30 years. Their primary focus, like I said, has been industrial, but they do a lot with retail and office. I'm not really familiar with their hospitality stuff, but I don't know that anybody's doing hospitality right now anyway.
No, hopefully not.
Yeah, tough stuff.
Let's see.
Anna, we're coming up to our mark here.
Yep. Have you looked into converting distressed retail properties into industrial flex, and how do they compare cost-wise? Marina's been trying to get this question answered. I'm sorry, Marina.
Yeah, absolutely. That's a great question. The biggest problem you have, and I've had there in terms of those discussions, is the city. The city, because it's retail, they really hold on to that retail idea that eventually they're going to get that tax base back. They get a lot of taxes from a retail outlet. So the Kmart that I bought in a distressed situation. Actually, it was vacated, and it was, I've never had opposition like I've had on that redevelopment with the acquisition of that Kmart and converting it to multifamily. But the reality is there was no other option. Retail is gone the way we know it and have grown up knowing it. And going forward, it's changing and converting. So you're going to see a lot of those retailers convert to storage, I would guess, storage units. You're going to see a lot of them that'll convert to family fun centers, entertainment centers. I've seen a lot here in Utah already switching to kind of a food entertainment, race car track, internal. I mean, it's crazy what we're seeing. Bounce houses, is more entertainment experiential than anything else.
Yeah. I think it's harder to convert them to industrial though than some of these others.
You showed a chart. Sorry, you showed a chart on the square foot on resale. I think it's the sales comp slide, Neil, and it was considerably lower than other resales. Can you show that chart again?
Sure.
And it's asking us to comment on potential additional upside. I mean, we didn't underwrite the project with those higher numbers intentionally. So, if we end up getting 165 a square foot, it's a lot more money, but that's not how we underwrite.
Yeah, the honest answer to that is, we try to look at, can we get to a certain return profile? And if we can get to that return profile, then we don't try to mess with the numbers. So yeah, there's nothing in this market that is sold for less than, you know, this 146, this 159. And then I'm not sure if that 271 is a true comp, but 161,
161,
166.
166. So
Right.
yeah,
So there's a lot of room potentially to kind of sell at a higher number. But I mean, there's no point in at this point saying, yeah, we could potentially have higher returns. We could, but then the market could also change. So it's nice to have this cushion. So we're just going to stick with 22%. So yes, potential, you know, upside. We're not going to speculate.
Let's see. Maybe I'll have Rich and Neil reach in and pick out a question.
Yeah. Let's see what else is remaining. I see 80 of them in
81.
the Q&A
I know,
box.
but there's a lot of them that are
Yeah.
you know, pretty similar things.
Mhm.
How come nobody's asked me about golf? That's what I keep looking for. So I'm searching.
Yeah, I see all the golf trophies in the background. They're like,
So when is the money due? You'll get that information in the emails that are sent out with the docs. There's very specific information about timelines that are sent out. I don't know if Neil has mentioned that we do give priority for the first 5 days of docs coming in. Priority is given to 100K and higher. If you're putting in 75K at that time, your docs will be put on hold, and then if there's space, then we will, you know, bring the 75Ks in after that 5-day wait period.
Mm-hmm. Yeah. So I'll take an easy one. So will you be issuing a K1 for tax reporting for passive investors? Yes, that is our standard methodology. We'll issue a K1 each year. And I'll take that one as my
do you know the average cost per square foot to build Woods project? If you don't know that, I think it's in the investment summary. But
I think it's in the investment summary. I'd hate to say it right now where I don't have it in front of me.
Yeah, guys, we have this gorgeous investment summary with phenomenal amounts of information that we couldn't possibly cover in 40 minutes. Yeah. So please do look. We work super hard on it.
So sorry, I'm trying to pick a question. It keeps refreshing because people keep asking more. Let's see. Yeah, let's see. Well, look, I'm going to jump on this one just because it says Rich confused me. Morris said, Rich, I'm sorry. Rich confused me. So you may sell one individual building and keep the others. I think that's probably as much for you guys and Neil and Anna as anyone else. But I think there's the option. I think if
it's
we're
the option. I mean, we don't, I'm not sure we're going to do that. Yeah. But if somebody comes and makes us a crazy offer just because they like the building and they're an owner occupier, it could change things. I mean, but it would have to be a substantial change or substantial increase in the profits for us to sell them one at a time, right? We may also sell it that way if it's a bad time and we need more cash.
Yeah. Yeah. So one of I think the question is sorry, I got another. I just saw a question pop up about golf. I don't know who it was, but I appreciate it. Talking about it really. So someone comes to us and we have a projected return of $144 per square foot, and we get an offer and says, "Hey, we want to buy this for $180 a square foot." I think it would be hard for us, and we obviously the three of us and Neil and Anna have a lot of experience in this, but we have a fiduciary responsibility to all of our investors to say, "Hey, look, we may be able to maximize more out of this, but the reality is it's above our projected exit. And if we can get more than our projected exit and perform better than we think we can, we'll push it up the best we can, but we don't want to risk not closing on something that allows our investors a return higher than what they anticipated."
Yep.
Yes. Are Grocapitus or Rich planning any more distribution warehouse type projects?
I will leave you guys guessing on that one. So I think it's a strong market, and we never get into a space just to do it once. That is not worth it. The learning, the management, it's never worth it to go out and do a one-off project. That's all I'll say. All right. We'll take that as the last questions. I know there's almost 200 of you at the I don't know, what is it? This is the 1.5 hour mark. So thank you for your interest. I think about 199 of you answered the poll, so we've got your interest levels. We're going to be sending docs out to you guys very shortly. So I want to thank Rich.
Oh, let's just clarify that because we'll get a lot of emails on that.
Yep.
So docs are going out tomorrow evening, California time.
Yep.
So, you know, like 6 o'clock California time. They're not going out before that. So everybody gets the docs at the same time. The Wednesday webinar and the Thursday webinar, everybody's going to get the docs at the same time. And docs, the timeline on when you sign your docs is how your queue in the raise. Mm-hmm. This poll doesn't have anything to do with you getting a spot in the raise. It's all about the timestamp on the doc.
Yep, that's a very important one. I should say that more often because we've had so much trouble with it. All right, people just think that, oh, I put my I put my spot in the poll now. I'm good. No, it's definitely
it is the most fair mechanism. So everybody's on the same playing field. We don't play preferential to anything other than that 5-day preferential to 100K and above. Otherwise, everybody's on the same playing field. No one has any leg up on anyone else.
Cool. All right. Well, Rich, I want to thank you for this incredible education on Flex. And thank you, everyone, for joining us. If you have questions, please feel free to let us know by email. We'll be happy to answer your questions. Have a wonderful rest of your evening. Thank you.
Thanks, everybody.
Thanks, everyone.
Bye-bye.